Hello and welcome. We've got a really fascinating economic puzzle on our hands today, centered right in Central Europe. You've got these neighboring countries, right? Seem to be on the exact same recovery path, but now, well, they're heading in completely different directions. Just take a look at this. This chart is pretty much the whole mystery in a nutshell. For 2024, forecasters are seeing Austria's economy actually shrinking by 1.1%. But then you look right next door, and the Czech Republic is set to grow by 1%, and Slovakia by over 2%. How is that even possible? They were all on the same team just a little while ago. So what on earth happened? And that's the big question we're tackling in this explainer. We're looking at a group of 5 countries: Austria, Hungary, Romania, the Czech Republic, and Slovakia. They all had this great, synchronized bounce back after the pandemic, but now it's like they've hit a major fork in the road. Our job is to figure out why. Okay, so let's start by setting the scene properly. You really have to understand just how in sync everything was at the beginning, because that's what makes this split so shocking. If you rewind to 2021, the recovery was absolutely booming across the whole region. I mean, Hungary posted a massive 7.1% growth, Romania 5.7%. And this kept going. Even into 2022, Austria was doing great, growing at almost 5%. Everything, and I mean everything, pointed to this shared upward path. But then 2024 hit, and the Great Divergence began. And for Austria, look, this wasn't just some minor blip on the radar. This sudden pivot into negative territory kicked off its most prolonged period of economic weakness in nearly 30 years. That's a huge warning flag. Something fundamental had clearly snapped. All right, time to play detective. Let's get into our first big clue to solving this mystery. And it has everything to do with what was happening inside these economies, away from the big global headlines. It's all about something we can call the domestic engine. So what went so wrong for Austria? Well, a huge piece of the puzzle was its reliance on the rest of the world. Its really powerful manufacturing sector, which is a massive driver of its economy, fell by 5.6%. See, when global trade slows down, an export-heavy economy like Austria's feels that pain right away. And this right here shows the 2 completely different models at play. Austria was super vulnerable to an external shock, but its neighbors, the Czech Republic and Slovakia, they had this powerful domestic engine just humming along. Their growth was being powered from the inside by their own citizens out there spending money. So what was fueling that domestic engine? The secret sauce, the crucial difference, was real wage growth. For the first time in a while, people's paychecks were actually growing faster than inflation. That meant they had more money to spend, more purchasing power, and all that extra cash acted like a shield, protecting their economies from the global slowdown. Now let's move on to our second clue. This one takes us out of the real economy of jobs and spending and into the world of high finance and central banking. This is where we see a really big policy trade-off that pushed these countries even further apart. And Romania is the perfect case study for this. See, unlike Austria or Slovakia, Romania has its own currency, which means it runs its own monetary policy. And after the pandemic, boy, did it use that independence. It basically decided to fuel a boom with a gigantic increase in credit and lending. And when I say gigantic, I mean it. By the middle of 2022, credit growth in Romania peaked at nearly 18% year on year. That is just a massive injection of cash into an economy. But you know what happens when you pour that much fuel on a fire, right? It had a direct consequence. Inflation shot through the roof, hitting 12%. And this created a classic boom-bust cycle. The economy overheated, and the central bank had no choice but to slam on the brakes and tighten policy hard. That's the price of having that policy freedom. You get volatility. Now, let's contrast that with countries that are inside the Eurozone, like Slovakia. They don't have their own monetary policy. Nope, they follow the lead of the European Central Bank, the ECB. And this creates what economists call the one-size-fits-all problem. A policy that's designed for the entire euro area might not be the right move for one specific country at one specific time. And we saw this problem play out right there in Slovakia. The ECB raised interest rates to fight inflation across all of Europe. But for Slovakian businesses, those higher rates made it way harder to borrow money. It caused corporate lending to basically grind to a halt, even while their own consumers were still spending. So it all boils down to this fundamental choice.
On one hand, you can be like Romania and have total policy control, but you risk these wild, volatile boom-bust cycles. Or you can be in the Eurozone, get more stability, less inflation risk, but you might have your growth held back by a policy that just isn't tailored for you.
Okay, we've looked at the clues, we've seen the difference between relying on yourself versus the world, and the big trade-offs in monetary policy. So let's bring it all together for the verdict. And there's a final twist. The verdict is pretty clear. The absolute key difference maker in 2024 was the strength of that domestic engine. Economic resilience came from everyday consumers who were finally seeing their wages grow faster than prices were going up. But here's the twist, and it's a really important one to watch. That very source of strength, that healthy wage growth that basically saved the day this year, could become the central problem from next year. Which leaves us with this final, really thought-provoking question. If these real wages keep climbing and climbing, they could easily spark inflation all over again. And if that happens, central banks, both the independent ones and the ECB, they're going to be forced to step in again, raise rates, and slow everything down. The solution of 2024 could very well become the problem of 2025. It's a true economic tightrope walk.